Karthik,
Yeah.
is my video stuck by any chance? I see it is stuck here. Okay, now it's working.
I'm just waiting for a green signal.
Huh.
I think I feel like okay.
Yeah.
Yep. Hi and welcome to Bullsmart Stock Academy. Hope you are all doing great. Hope you are all safe too. And yes, it's going to be a great session today. This is the first of many YouTube live sessions that we are having here at Bullsmart Stock Academy. And we have with us none other than Kathick, who is a fan favorite at.
Thank you, Karthik. Thank you.
How are you doing?
Yeah, doing good. Things are going good.
Great, amazing. So, Karthik, I am not going to take much of the time and I'm going to keep it very simple with you. I'm going to tell what the topic is to our audiences who are watching us live. The
Okay.
topic is Beginner's Guide to Mutual Funds, right? That is what we are going to talk upon. But
That's
before that, when I said that you are our fan favorite and we all love you here at Bullsmart, I want you to tell a little more about yourself to all the people who are watching. So the stage
yeah,
is yours now.
sure. So I'm into financial trainings since last 15 years now. I run my own training company. Prior to starting on my own as a financial trainer, I worked in the financial service industry. I worked with a bank. I worked with a mutual fund company. I have close to 18 years of experience in this space. So interacting with people, conducting different workshops on financial aspects is my domain.
Amazing. And apart from this, what do you like to do, Karthik? You have to ask you something that love, maybe traveling or something like
Oh,
that.
I love traveling. I love road trips. I love long drives. I wouldn't mind driving all night and then work. Um, I'm a
Amazing.
I'm a road junkie.
Amazing. So let's get started with our session. Like I said, the topic for today is beginner's guide to mutual funds.
Yeah.
So I'm going to directly go on, and ask you, because I'm also pretty much new to this whole financial field and the investment field.
Yeah.
So we've seen in the last 2 years, or particularly during the COVID period, there have been
Correct.
a lot of people who have started investing.
Hmm.
So I just wanted to see like what according to you, is mutual funds and how do they work? What is your sense behind that?
Yeah, sure. So I think we are definitely living in exciting times. I would like to divide the investment journey of India as two eras. One is pre-COVID and then post-COVID. Okay, if I were to give you a simple analogy to explain mutual funds, I think during first lockdown, the virus was not so prevalent, but there was always that fear. But we were all locked at home. One interesting thing what we did was exploring Zoom meetings or multiple online meetings and so on. And then the second largest exploration happened was in the cooking space. If you remember, Karthik, I mean, we used to talk about Dalgona coffee and
Yeah, amazing.
whatnot.
It was on my lip and you just took it away.
Yeah. So we loved experimenting, right? I mean, irrespective of the gender, we love cooking and all that. Imagine if you were to do the same thing on a daily basis, right? I mean, imagine making Dalgona coffee or experimenting new cuisine every now and then. You might have all the expertise with you, but doing something on a regular basis requires a different skill set altogether. So if we were to really bring the same analogy to investing, okay, look at just equity markets alone. There are a larger set of people who started investing in equity markets, started buying stocks, trading in stocks. All these things are happening. But for serious investors who are looking at long-term wealth creation, okay, stock selection itself is a very big, daunting task, I could say, right? Look at National Stock Exchange. There are close to 2,000 odd companies, 18 broad sectors, and multiple industries below these sectors, which are subsets. How are you going to really look at them, track them on a regular basis. And then it is not just about studying sectors and stocks, it's also about understanding the economy. What is happening to the global scenario? We don't know what would affect market, what would affect your stock. There was when during my initial days, I always felt that if the company is fundamentally strong, the stock prices should go up. That broke the myth in the initial few years itself. Company might be fundamentally strong, but stock prices need not go up momentarily, right? So different sectors perform well at different economic conditions and all that. So that's when I realized this is something where it's always good to leave it to experts. Okay. Here in this example, mutual funds are those experts. In a nutshell, what they do is they collect money from us and they handle it for us. It is their full-time job. They have different teams which tracks different sectors. There are people who are tracking economy. It is their full-time job. Let them do the job for us, so that we have all the time in the world to focus on what we are good at, right? um, so imagine if you love doing everything, you can't stitch your own clothes, you can't cook, you can't do everything by yourself. It's always good to take the help of experts. I think mutual funds are those money management experts.
So do we call you also as an expert then? Like
Um,
mutual funds.
no, I am an expert in delivering the talks, but in terms of managing my money, I know, like, I go back to mutual funds to handle my money for me.
Amazing, amazing. And just to give a, for everyone who's watching, if you have to tell them how does it work,
Okay.
what would your thought process behind it? Like, I hope mutual funds are really easy because I've done them on my own because you just need to analyze. But in your opinion, because you would definitely deliver it in the best possible manner. So what would you say? How do they work?
See, very simple. They collect money. It's a pool of investment from investors under one scheme. And based on the objective, that means, let's assume if it is an equity mutual fund, whatever money collected would be invested in the broad range of equity shares. Let's say money invested in 40 to 50 different companies, right? If you look at a generic equity fund like a flexi cap fund, or even for that matter, large cap fund, invest across multiple sectors.
Okay.
So, with whatever money we are investing, it could be smaller amount or a bigger amount, you get exposure to multiple stocks in the portfolio and multiple sectors.
Okay.
Okay, not many investors would be aware of this. Every month, mutual fund companies publish something called as fact sheet. You can always refer to fact sheet, or it's a freely available information on the internet. You go and type a fact sheet of XYZ mutual fund company, you can download, and then you can see the portfolio yourself. You will know where is that they have invested your money and what portion, and so on. It's as simple as that. They handle the money for you on your behalf by diversifying the portfolio.
That's a learning for me. Like I already have started taking down points as to, next month or start of this month I'm going to go and check where is my money being invested.
Then you can
Yeah.
see the portfolio yourself.
Great.
You
So
will know
moving on,
where is that
sorry,
they have
go on.
invested
Yeah.
your
I've
money
seen a lot of
and
people
what
who say that,
portion,
okay,
and so
let
on.
me look at
It's
the
as
fact
simple
sheet,
as
let
that.
me compare the fact sheet stocks, and then my stocks. Is there any change?
I'm not saying that's a advisable practice, but there are people who do that as well.
Okay. Okay. Great. But my next question, Karthik, is so you might be saying, why is Karthik so happy, sitting on the other side? I'm specifically happy because I got my salary today, and I'm very sure a lot of people who are watching also would be happy because today is salary day.
Yeah.
Now, when it comes to salary day, which means you have some money in your account. Obviously, you take care of your bills and your expenses, but then you would definitely want to save some money.
Yeah.
But and let's say we want to start saving in a mutual fund now that you told us what mutual funds are and how they work. But do you think mutual funds are risky, Karthik? And what is your opinion on that?
See, risk is a very relative term. We, for sure, we know that mutual funds are risky primarily because every time you listen to an advertisement by a mutual fund, it comes with a risk disclaimer. That is, mutual fund investments are subject to market risk. Please read all the scheme related documents. There's a very interesting story to it, right? I mean, I have a friend who's daughter said, 7-year-old daughter said, Papa, I know what mutual funds are. We were really happy. Then when we asked what mutual funds according to you, she said that market risk is your mutual funds. So we have ingrained the concept of risk into the investors. But I personally think risk is there everywhere. I think crossing the road is also risky. I think cooking in front of the gas is risky. I think life is full of ups and downs, right? But having said that, not all mutual funds invest in equity market or equity stocks. There are some mutual funds which invest in bonds. Okay. For example, there are debt mutual funds. Under that, there are funds like overnight funds, probably as safe as any other bank deposit, ideal for people to invest between 1 to 7 days, right? So there are debt mutual fund schemes. If you want to invest in gold, then there are gold ETF. Like, let's simplify, call it as gold funds. SEBI has given permission to launch real estate mutual funds way back. So I think in the coming years, we'll see real estate mutual funds also.
More and more.
So in a nutshell, wherever an individual would want to put the money, be it in equity or gold or real estate or bonds, mutual funds tell you, I will give you that option in a much more efficient way. I will create that portfolio for you, right? So all an individual needs to understand is, what is my requirement, me as an individual, what is the need, according to my need, select the right fund. So that is something very essential. But please understand, not all mutual funds carry same degree of risk.
So there, like you said, there is ups and downs. And one thing that comes to my end, and on a lighter note, I want to say risk hai to ishq hai. So, you don't go get anywhere. So you should definitely try. So leading on to the next question, Karthik, you said that these mutual fund investors, they take your money and they invest in different stocks.
Yeah.
So why should I directly invest in a mutual fund and not directly invest in a stock itself? Like, let's take my example. Why should I do an SIP or something like that? And why should I not directly go to the market and buy the stocks from a company?
Yeah, I mean, many people do believe it, and there are certain set of experts who are doing it really well. But the question is, can all of us do it? Itself is a question mark. Okay. So whenever I've had interaction with, say, individual investors, I ask this one question: that what are some of the things you look at while investing in stocks? So the most common answer what people give is, say, fundamental analysis. I look at balance sheet, I look at profit and loss account, and so on, right?
Yeah.
So balance sheet, profit and loss account, all these things, you're looking at the historic past of the company. Okay. Now let's look at an interesting analogy to this. Like, let's say you're driving on the road, your own car. Would you look at the rear view mirror only and drive the car? If you're looking at only rear view mirror, what are the likelihood of you reaching the destination safely?
I might not reach the destination if you have to ask me personally. Yeah, I understand your question. Yeah, please go ahead.
Sorry. So essentially, we also should be looking ahead also, isn't it? So how many of us would have looked at, okay, what are the future prospects and what entails in their future plan and so on, right? When you look at a mutual fund, essentially, they look at both the aspects. I'm not saying past is not important. Past is important, but future is also equally important. If you just looked at only historical statements, 2010 and 11, Nokia was an invincible company, right? With 60-70% market share. Then all of us should have invested only in Nokia in the telecom space. So, but that doesn't work. I mean, industries where the companies or the environment is very dynamic these days. So future outlook is very important. So that's where when we say mutual fund, we generally associate the word fund manager to mutual fund. But remember, there is a large team working behind it. They interact with buy-side analysts, sell-side analysts. They sit through the presentations. So they get their perspective and then handle the portfolio for us. How many of us have an access to information or to the kind of interactions what they have? What kind of interaction we end up having? Right? And then stock selection itself requires a lot of effort. my argument is, why should I waste my time on stock selection? By doing stock selection, I might get, say, 14-15%. I'm just hypothetically saying. But at the same time, from a mutual fund scheme, if I get even 11-12%, I'm happy, because I would have saved that amount of time. I can focus on earning more money.
Yeah, diversify your
Yeah,
investments.
yeah, exactly. Your own income stream, you should diversify. Focus on doing what you're good at.
Amazing. So yeah, like maybe having more awareness, then maybe then going into a stock would be much better. And if you have the time, like you said, then definitely go into it. But mutual funds are much better because someone is handling it for you.
Correct.
So on that note, I want to know from you, like, because we are sticking to the topic of mutual funds, what are the different type of mutual funds like in the market?
See, we can look at broad categories. Like, for an individual, what are the different asset classes available to invest? First one being fixed income. That is, examples like bonds or fixed deposit. All these are examples of fixed income. That is one asset class. Second is equity. Third is commodity. When we say commodity, it's gold and silver. And finally, real estate. 4 asset classes. So you can have mutual funds investing into each of these asset classes separately. So that would be a primary categorization. So when you look at equity, so under equity, there will be again multiple subcategories. SEBI has done a categorization or defined mutual fund categories. This is again a public domain information. One can go to Google and then search the categorization of mutual funds, SEBI. You will get a PDF. You can download it and see it for yourself.
Amazing.
The rule says each mutual fund company can have only one open-ended scheme under each category.
Okay.
So from that way, I think our life is a lot more simpler to really understand different categories of funds available.
So what is open-ended, like, if you have to give not
okay.
an example, but if you have to just explain it.
Yeah, of course. Open-ended funds are most of the funds what we see today are all open-ended funds. You can invest in them anytime. You can redeem money from it anytime. Whereas when we say closed-ended funds, they are fixed maturity plans, in the sense at the time of launching itself, they will tell you this is a 3-year plan or a 5-year plan.
Okay.
The fund ceases to exist. That means the fund closes after the maturity. The money will be given back to you, to us as investors.
Okay.
Yeah.
So it's better to have an open-ended, or like knowing that the money is going into an open-ended, or is it like equal at both ends?
No, I see. Like, I would say the most prevalent schemes what we invest today are all open-ended. These days, I think even in the past, there are certain category of debt mutual fund schemes which are really famous. We call them as FMP, fixed maturity plans. So that theme is really coming back in again now. I think one can consider that in debt space. Debt, it makes sense, but for equity, I don't think close-ended makes sense.
Great. So moving on, to my last question in this particular mutual fund kind of, understanding the basics of it. My next question is, what are passive funds and what are ETFs, and how are they different to each other?
Yeah. I think ETF caught the imagination of Indian investors again, I would say 2019-20 onwards. Prior to that, ETFs were not so prevalent. Even though ETFs in India came way back in 2001, they were not that famous, right? It became famous, or the passive investing became famous 2019 onwards. I think the kind of growth what we have seen in the last 3-4 years has been phenomenal. Okay. So we need to understand what are active funds. With that, it's easy for us to understand what are passive funds. Okay. Suppose I'm launching I'm a mutual fund manager running an active fund in large cap space. So what is large cap? Top 100 companies based on market capitalization is large cap. Okay. So what happens if you look at the index? Say, let's say you look at Nifty 50 or a Nifty 100 index. In that particular index, the index comprises of that many stocks. Nifty 50 comprises of 50 stocks representing different sectors. If you look at banking and financial service sector, it almost has 30% plus kind of a weightage there. Okay.
Weightage. Okay. Mm-hmm.
Then individual stocks also would have weightage. Individual stock like Reliance Industries might have, say, around 10-11% weightage, and TCS and so on, right?
Okay.
So now, me as an active fund manager, at the time of investing, I will decide that I will go overweight on banking financial service sector. I'll say, okay, instead of 33%, I'll give 40% exposure.
Okay.
And in IT, I will reduce the exposure in comparison to benchmark. So whatever deviation I'm taking, I'm doing it in reference to the underlying market, that is benchmark. I might say, okay, I'll not give 10-11% weightage to one stock. I will reduce the weightage. So that means I am taking these active decisions with the sole purpose of outperforming the underlying index. Correct? So I'm taking these decisions with the best possible intent of beating the market. If everything goes well, I beat the underlying benchmark. It goes well, fantastic. What if my decisions don't go right? Right? Then I would be underperforming the market. Over and above, as an active fund, I would have charged higher expenses. Like that. Then what are passive funds? Passive funds, they replicate the underlying index as it is. Okay. There is no active fund management involved. Okay. If there are 50 stocks, even my portfolio would have same 50 stocks in the same weightage, two different sectors and different stocks. Because there is no decision making process involved there, the charges involved by these passive funds are much lower. Okay. So that is the entire universe of passive funds, which says, boss, I don't want to take decisions based on my views. I will just follow the market. But there, one can invest via index funds or ETFs, exchange traded funds. Both are same. Let's say if I invest through Nifty 50 index fund versus Nifty 50 ETF, at the end of the day, the portfolio is going to be same for both the cases. But then, how are they different from each other is where the interesting scenario folds out, right? I mean, if I have to purchase an index fund, I have to interact with the asset management company, right? The mutual fund company will allot the units or redeem the units. Whereas when it comes to the matter of ETF, the word itself suggests exchange traded funds. The units of these mutual fund schemes are listed and traded in stock exchange. Which would essentially mean, if you as an investor, if you want to invest in an XYZ AMC's Nifty ETF, you need to have Demat account and then buy or sell these mutual fund scheme units at real-time prices via stock exchange. You're not interacting with the AMC. Okay. So that's the primary difference. But otherwise, these days, if you see, the expense ratio is also almost fairly similar for most of the index funds and ETFs. I think it's up to an individual what form of passive fund they want to invest. Yes.
Yeah. Amazing. So there is a difference. I don't know, maybe minor or major. You would be maybe able to tell it better. But as an individual investor, let's say for example me. I always think that I've been always trading in passive mutual funds only. Is it true, or am I wrong in what I'm saying?
See, lot of times, we take these concepts into heart very seriously. Passive versus active. Okay. There is no rule which says that if you have invested in passive, you cannot invest in active. Right? When you're building a portfolio of mutual funds, it is not necessary that all your funds should be passive or active. It can be both.
Okay.
You can decide and then say, okay, look, again, don't take this as recommendation. I'm just giving it as an example. You can always say, look, in the large cap space, maybe instead of investing in two active funds, I'll buy one passive fund and one active fund. But maybe in the flexi cap and mid cap space, I would go for active funds only. because
Okay.
these active funds, if you see, especially in flexi cap, mid cap, small cap space, the outperformance is still pretty much prevalent, and then the gap is still pretty big, an interesting gap. Even if it is 2% extra year on year kind of a CHER, over 10 years, it can make a significant difference. So don't make it as an active versus passive kind of an argument. You can always have both in your portfolio.
Both ways.
Yeah.
Yeah. It's about understanding how you want to deal with
Oh, yes,
questions.
yes.
Great. So coming back, and summarizing your, you put it really well. My next question is going to be, like I mentioned, quite happy that today my salary has come in. I'm going to definitely allocate some of those funds towards my expenses and bills. But I wanted to know, apart from that, now if I want to put my money into mutual fund, what are the expenses that would come up for me, or for any investor?
Okay. Mutual funds follow a very transparent methodology in terms of charging the expenses to investors. Okay. What we need to understand is there are broadly two types of expenses which are involved. The first one being exit load. Exit load is something which is charged by selected set of schemes. Not all schemes charge uniformly. It differs from scheme to scheme. But basically, the scheme says, if you exit before a stipulated time, I will charge you something.
Okay.
But what you need to understand, mutual fund companies cannot use this exit load for managing their own expenses or paying commission to the distributors. That cannot happen.
Okay.
Whatever expenses charged under exit load, that will be put back to the scheme and distributed amongst the existing investors.
Okay.
So it is as good as saying that indirectly a mutual fund scheme is telling, sir, I don't want you to exit before a stipulated time. It's a discouragement technique. That's it. So that is one form.
Okay.
The second is the expenses, that how will the mutual fund company run their expenses, right? I mean, they have to pay brokerage, they have to pay audit fees or registrar transfer. There are multiple expenses involved in running a mutual fund scheme. And who has to pay that? We investors have to bear those expenses. We call it as total expense ratio. The word is TER. That's an acronym what we use. Now, mutual fund companies cannot charge these expenses based on their whims and fancies, right? How much ever they want, they can't charge. SEBI has prescribed a slab. All you need to understand is, as the mutual fund size starts increasing, we use the word AUM, assets under the management. The moment that starts increasing, the expense ratio starts coming down.
Okay.
Which means a smaller fund will have higher expense ratio compared to a larger size fund will end up having lower expense ratio.
Lower expenses.
Yeah.
Quite interesting, because we don't look at things so much in detail, and when you get to know, there are so many. No, I'm not saying expense-wise, the number might be big, but to understand that where all the expenses lie is quite interesting also. So that you can also understand it. Yeah. So exit load, that is another interesting word. Exit load. It's a nice word that is given. Yeah, great. So moving on, Kathick, my next question is, me as a working profession, my colleagues here, and everyone watching, who is employed, or, who wants to get into the investing space. Can you tell us that what are the tax implications in mutual funds? Like, how does it benefit in the tax reforms, or when you are filing tax, or is there any?
Yeah. Investing in mutual funds generates broadly, it can generate two streams of income. First one being dividends, second is capital gains. Okay. What is dividend? Mutual fund portfolio is generating some profits, be it in the form of capital appreciation or in the form of interest or dividends, whatever it is. I mean, the portfolio is making money, and if you have opted for dividend option, so dividends are not paid to everybody uniformly. It's only for those investors who have opted for dividend option or dividend payout or dividend reinvestment option. Then those dividends are taxed. So that is one.
Okay.
Now in the mutual fund application, you see the word dividend anymore. We use the word IDCW. Okay.
Okay. What does it stand for?
Income distribution capital, I mean something like that. I'm missing the last word. Okay, so basically
That's okay.
distributing the income whatever generated by the mutual fund scheme. So
Okay.
dividends earned are taxed separately. The second one is capital gains. So what is capital gain? You have invested say 100 rupees. That 100 rupees has appreciated into 140 rupees, and you sell
Okay.
140. What is your gain? Your gain is 40 rupees. So that gain is treated as capital gain.
Okay.
But both are taxed separately and as a different head of income. Dividends are taxed in the hands of the investors. That means you pay tax in your hands, and it will be taxed under income from other sources.
Okay.
Even if you get 100 rupee dividend, you have to declare in your like let's say ITR, and then disclose that income from other sources you have received 100 rupees in the form of dividend.
Okay.
That's it's as simple as that. Now moving on to capital gains. The entire universe of capital gain can be looked at from where is that you have invested. If you've invested in equity oriented schemes, okay,
Okay.
from an income tax definition, the definition of equity stands for average 65%. That means the total portfolio. Say if in a mutual fund, if I'm handling 100 rupees, if I've invested 65% in Indian listed equities, that means
Okay.
we're not saying Indian companies listed in India, and the
Okay.
fund should have invested that money into stocks directly. Only then those funds are called as equity funds.
Okay.
Rest all other investments are called as non-equity. So what are non-equity? All your debt funds are non-equity, gold, and even international funds are treated as non-equity. Why? Because they are not listed in Indian equity market.
Okay.
So when you get excited and then say I'll invest in US markets, even though you are investing in stocks like Google and Facebooks of the world, income tax department says, sir, I'll treat this as non-equity.
Non-equity.
Okay. Now, let me explain the tax implication for equity in simple terms. The entire capital gains, the profits, whatever you made, we can divide either into short term or long term. The moment you invest, if you redeem the money within 12 months, that is within 1 year, that would be treated as short term.
Okay.
The short term capital gains tax is 15%.
Okay.
And on whatever gains you have earned, you have to pay 15%. And in excess of 1 year, like if your holding period is more than 1 year, then what you have to pay is 10% on the gains.
Okay.
But you don't pay 10% on all the gains. In a year, that if you're like up to 1 lakh rupees, you will get an exemption. Okay, capital gains.
That is capital gain.
Yeah. Suppose you invested 10 lakh rupees 3 years back. Today you're withdrawing 13 lakh rupees. That means you made a gain of 3 lakhs. So on the 3 lakhs, 1 lakh will be exempted. On balance 2 lakhs, you can you pay 10%.
That's quite logical, and I feel comfortable with that calculation. I don't know.
It's very simple. But
yeah.
see, there is also an element of tax planning, right? If you don't want all the money at once, you can break up your withdrawal over a period of time.
Correct.
By doing that, you get that 1 lakh tax exemption every year. So the tax implication could be lower.
Yeah, amazing. Quite interesting. And but moving on to the next part, like you said, in the start of it, that mutual funds are always termed as risk. Maybe there is a certain amount of risk involved in it. But what if there is a loss in mutual funds? Like, how do you deal with it? Or what is your suggestion towards that?
See, as human beings, we are definitely emotional in nature. The decisions what we take are emotional. Okay, you ask a fellow colleague or a friend of yours, you have invested in gold, okay, physical gold, or you have invested in real estate. Okay, let's go back to gold example. Ask for sure that next year what would be the gold prices. Can they give in writing?
Definitely not.
Definitely not, right? At least can you tell me for sure that gold prices will go up from here? for next 1 year. Will it definitely go up? We don't know. It can go down as well. Let's assume gold prices go down for some time. Do you feel, do you feel the risk? No. Why? Because you open the locker, you see that gold, it is there, you feel, okay, it is there. Someday gold prices go up. Same is the case with real estate. So gold and real estate are tangible assets.
Correct.
The perception of risk goes down. Let it be there. I will hold it. Someday I will sell it. Okay. Many people try to sell their plots. If they don't get the right price, they say, "Arey, bakwas, I'll wait." Okay. But the moment you look at mutual funds, they are completely intangible in nature. There is no touch and feel factor there.
Touch and feel, yeah.
Right? The moment there is no touch and feel factor, the perception of risk increases. Now, if somebody wants to reduce their feel of risk, I mean, this is an interesting way. Look at the fact sheet. If the mutual fund scheme has invested in companies like, let's say, Maruti Suzuki, SBI, or I mean, say ICICI Bank, TCS, say 40 such companies, you ask yourself this question: how risky these companies could be? Okay, can all these company go bankrupt or vanquish at once? If no, if you are fairly confident of India as a country, our future, and collectively these 40-50 companies, I think it's a no-brainer to assume that equities are not that risky. But what we need to understand is, every time we invest in equity, we start tracking the performance at regular intervals, right? Imagine our grandparents had an app for the real estate investment. If they got the price update every day and at a click of button, if they could sell it, then I don't think people would not have made money, right? Stay invested in equity for long term. That's how we manage risk and manage the emotional aspect also.
No, quite true. What you said, because I just look at it because as an investor myself, I just look at okay, what is happening in the market and everything. But the fact sheet that you're just saying today, which has really caught my mind at least, I've never seen it. And just a follow up question to you: that how many times should one actually look up at a fact sheet? Maybe when monthly gets a bit tough, understanding that people are working and everything. But how many times do you think that fact sheet should be reviewed of a company, or is it once a year? It's okay, or quarterly? What is your suggestion?
See, I mean, instead of saying looking at fact sheet, I would say review your entire mutual fund portfolio. Okay, to decide whether to hold on, or I mean, whatever decisions you want to take. But there's no again hard and fast rule. You should look at it for certain frequency. But I think too much is also bad. I would say probably year and a half, once in a year and a half review is good enough. It is like saying how regularly you do the health checkup, right?
Health checkup, yeah.
If you start tracking your BP and blood sugar levels every day, most likely you will get it, right? Yeah.
True. Very true, because I was just thinking like, maybe we get these quarterly, financial updates from all companies. So I was just thinking, would that be a better approach to see it in every quarter? But like you said, maybe if you see it also regularly, you kind of panic, okay, maybe is this the right time to remove the money?
The challenge is, Karthik, we all are smart, okay? The problem is, to a smart person, when you're giving them with data, we want to analyze, interpret, and act on it. Lot of times not acting on it also can be helpful. I'm not saying universally that's the rule what you need to apply, but I'm saying generally.
Makes sense. So following up, on the whole mutual fund, kind of topic that we are having here. So we all know about SIPs, right? Systematic investment plan. How does one, make money through SIPs or become wealthy in your opinion? Or do they become?
I think last couple of years, SIPs have been one of the brilliantly marketed tools. Okay. Now, even some entities which are in the business of charity, they use the word SIP. SIPs have become that famous. I've heard where people say, look, I don't like mutual funds, they're risky, but I want SIP. Okay. I'm sure many of the audience would know, but in simple terms, SIP, systematic investment plan, is method of investing into a mutual fund scheme or schemes of your choice. So when somebody wants to start with an SIP, essentially they need to make two decisions. First decision being how much they want to invest. That money will be deducted from their bank account on the date what you already decided every month or every whatever frequency you decide. The second decision to be made is which are the scheme or schemes they would want to invest. On the day you decided that money will be deducted from your bank account, it would be invested in the schemes of your choice, and then it goes on regularly. So that entire process is what we call it as SIP.
Quite. And I remember come back to your example always. That sheet that you show when we go to the universities, and you have your presentation. Over a period of time, one person has invested from 1990, if I'm not wrong. Leading up to 2008, and I remember the reaction given by each and every student. It's like, wow, so much money, so much wealth. So it's quite interesting, and maybe we can share it, in our next session with everyone or all the audiences as to how does that help, people actually, maintaining it over a period of time. How does it really help? But my follow-up question, to you is, we always hear these examples, the one that I just told you, but we do not meet a lot of these people. Is that because people do not talk about it, or do you think that these do not happen to everyone in the market? These are only very few people. What do you think?
Yeah, I mean, see, some of the wealth creation stories, what we would have heard is phenomenal. I mean, we envy that. Even I want to become, I want to emulate that portfolio, right?
Yeah.
And some of the illustrations, what we get to see, sometimes we feel, alright, it's so unreal, right? But what happens is, why is that we don't meet such people? Few reasons. One, first of all, being um, the mutual fund industry itself started evolving in the last 20 odd years or so, and then it has really caught up the moment in the last 10 years. Okay. We are active. Like, I remember when we used to talk about SIP, we used to say 2-year SIP, 3-year SIP. Very seldom we spoke about long-term SIP.
No.
But second, the interesting thing about being in equity markets is managing emotions, right? I think it's important for us to handle two types of emotions. One, when markets go down. So about 2 years back, I was doing a session in a small place closer to Belgaum. On that day, markets had crashed. I was asking them this question: today, markets have gone down. What would you do? I mean, it's very unlikely answer, but most of them said it's a fantastic opportunity for us to invest.
Wow.
So I think we have mastered, to some extent, we are in the process of mastering that art. When we say markets are going down, let's buy. I think that's what has happened in the last 2 years. Every time FIIs have pulled out the money, DII, domestic investors, have pumped in the money. So that part is taken care. What is the second part of emotion which needs to be managed? When markets go up, there's always fear that, acha, whatever gains I've made, what if that depletes in the next correction? Okay, because there is a general assumption when market goes up and down, we assume it keeps on going up and down. It remains in the range bound. It remains in the range. That's not necessary, right? Just because it is going up and down does not mean that it moves forward. It continues to move forward as well. If somebody is holding on, has a investment horizon of say 10, 15 or 20 years, then I don't think they should worry or fear about Sensex at say 61, 62,000 levels or Nifty at 18,000 levels. All these are some of the levels which we will cross any which way, right? So the biggest fear one has to overcome right now is when markets go up, don't book your profits. Okay. I'm not saying this about stocks. I'm talking about mutual fund portfolios, because the fund managers are actively toggling between different sectors and industries and stocks. They are doing it based on market conditions. So all you need to do is, if you have conviction on those funds and fund managers, stay invested.
Great. I remember coming back to the college events that we did. I remember your one of the slides which said about the industries or that those particular sectors. For some years they're up, then they go down, and then coming up. It's a cycle, isn't it? Like,
Yeah, yeah.
if I'm not wrong, it's a cycle. But now moving on, we've spoken about SIP, which is regular investment, but there are also one-time investments, right? So which one would you say is better? Do I keep investing regularly or one time and then I maybe don't look at it for the next 10 years, just for example.
It's always a classic debate, right? One time versus SIP. Which one is better? Okay. Let me put across the question to you in turn. Let's assume that you love cricket. You regularly play cricket for a particular team. Now, you as a batsman, your agenda is to score runs, correct? Given a chance, okay, given a choice, I think I'm sure all of us would have dreamt of this in our childhood, that every ball I would want to hit a six.
Correct.
Correct. Now, how would you retain the strike for the next over? Last ball, you take a run and then retain the
Single.
strike, right? I mean, I
Yeah,
think this is the dream what all of us would have visualized or imagined and so on.
definitely.
But it is not possible to hit boundaries in every ball, right? We need to respect the
Unless
opposition.
unless you're Sehwag.
Even then, I mean, even then, I would say, like one needs to respect the bowlers, right? I mean,
Yeah.
when there is a very tough ball being thrown at you, it's probably respectful to take a single or a double instead of wasting that ball, right? So, in a cricket innings, batting innings, it's important those how many ones and twos are you taking on good balls, and if you spot a loose ball, go for a four or six. That's how you build your innings. That's where you score century, right? Now, if my objective is wealth creation, how I do it is secondary, right? I mean, whether I do it through SIP or lump sum, how does it matter? If my target is to get 10 crores in next 20 years, it doesn't matter how I get it. But what happens is, will I have lump sum money every month? No. From my regular income, keep investing regularly. Once in a while, say you get some bonus, you get some incentives, or like somebody in the family gifted you some lump sum money, or some real estate deal, you got a lump sum. You invest that in market. So there is no harm in saying that I'll do both, right? A mutual fund company or a folio won't say, "Sir, this is SIP folio only, ma'am. You can't invest lump sum into this." That won't happen. You can do both. Treat your folio as open-ended or open, easily accessible savings account. Whenever you want, you keep putting the money. Whenever you want, you can withdraw. That's secondary, right? So have both. Do not get into this debate of lump sum versus SIP. Okay,
But
mathematically
is it in relation to having an experience or something like that? Because you would want to start somewhere and then you feel good and then you feel the other way is a bit risky. I don't know.
yeah.
Just a follow-up
See,
question.
if I didn't know anything about mutual funds, if somebody told me start with 500 rupees per month or 2,000 rupees per month, I might be open to it, right? If somebody asked me suddenly, "Arey, invest 10 lakh rupees," I would probably think twice if I didn't know anything about mutual funds. That could be a starting point. But what I'm saying is regular, ongoing basis. You don't have to look at this versus that. You can have both in your portfolio. When you're investing via lump sum, you can always be cautious and take a route of STP, systematic transfer plan, because there is always that fear. I put in the lump sum today. What if market crashes in next
Clashes.
1 or 2 months? So to avoid that kind of risk, you can always take STP route.
Oh,
Yeah.
great, and it's a long conversation, but one right thing that I think you said is to not get into the debate and start overthinking it.
Yeah.
Whichever obviously you feel is comfortable, you start with that,
Just
or the
yeah.
best scenario, put money in both and book, make yourself wealthy, over a period of time. So moving on to making more money, what kind of mutual funds should, let's say, a person invest if he or she wants to start investing?
Okay. Again, let's not treat this as a recommendation or advice. I'm just giving a broader construct around this. Okay.
Uh,
I have seen many people starting their investment. I mean, first time investors starting their journey into mutual funds, starting with sectoral funds or thematic funds. What happens is within equity mutual funds, not all equity funds would carry same degree of risk. And not all the times high risk would entail or would generate higher returns. Right? See, if I were to give you this example, let's assume that you have two batsmen in your team. Like one is, say, Rishabh Pant, who would score, say, in a T20 match, 60, 70 runs in a match. But for that to happen, you might have to wait, like, let's say, in 1 in 10 matches, he might score that innings. Okay. Versus maybe a Surya Kumar Yadav, probably in every match, he scores, say, 30, 40 runs for you at a good strike rate. Whom do you want in your team? Let's assume you have only one batting spot available, batsman spot only. Most likely you would say, yeah, I would need Surya Kumar Yadav, because at the end of the day, it is not scoring 60, 70 runs in 1 of 10 matches. It's about those scoring consistent runs. So many of us really say, investing in some of these regular equity funds are boring because they might not generate very high returns. But what we can, in simple terms, we can do is the entire universe of equity funds can be divided into two parts: all season funds and seasonal funds. All season funds are something which generally they do well across market conditions. Do well is a relative term. Okay. When markets are going down, seeing lesser losses also means doing well. Okay. So what are some of the all season funds? I would say large cap fund. Okay. Or an index fund, flexi cap fund, mid cap, multi cap, tax saver. These funds can be called as all season funds. And larger chunk of your portfolio could go into all season funds. But at the same time, some of the funds are seasonal. That means they do well only in a given particular market cycle. Like sectoral fund is highly seasonal, investing in one single sector. Look at what happened to pharma. Till 2018-19, the government was restricting the prices of pharma industry, how much medicine can cost, how much a transplant could cost, and all that. Pharma sector was not doing well at all. But none of us anticipated COVID, but that happened. Pharma sector went into a different league.
Yeah.
Right? You will always have these sharp ups and downs for sectors. Same is the case with theme, infrastructure theme, or say, any of these themes. They tend to be more volatile in nature. Okay. So that is why I am not saying do not invest in small cap or sectoral or thematic, but a small allocation should be good enough. Okay. An analogy could be looked at for this would be a meal plate example, right? I mean, what we eat, we love eating carb, that is, say, chapati, rice. We need dal for protein, and we eat vegetables for like fiber, etc. Right? That forms the general part of the meal. But by looking at this meal does not add excitement. How do you add excitement? You add papad, pickle, and some, like, let's say, all that extra things what you add, or some seasonal vegetables, are something which adds excitement to it. Right? Just because you love papad and pickle, you can't make that as your main meal. Right? So for me, all seasonal funds are papad, pickle, or different cuisine. Like I love trying Mexican cuisine once in a while, but how good are we to adopt to some other cuisine on a daily basis? That's very difficult, right? I mean, so build all season and seasonal portfolio and construct your portfolio accordingly.
Great. So moving on to, I think, I think we have another 5 minutes, and we'll try and summarize it also from your end. But one last question that I had from you is, we see there are a lot of categories in funds, right? I mean, if I'm not wrong, it's equity, debt, and a new one that has come up in the market is the hybrid. So how do one, because you've spoken about equity and debt in detail in the previous week. So how do one use the hybrid funds in the mutual fund portfolio?
See, equity portfolios are predominantly meant for long-term investing. Say somebody is invested on a horizon of, say, 5 or 7, or maybe upwards. It's best suited for them.
Okay.
But not all the investors all the time would say, I don't want this money for 5 7 years or beyond that, or it's meant for my long term goal. So you might want this money back maybe in 3 4 years, right? But from 3 4 year horizon, you might say fixed income or bonds, FDs might be boring, or they might not be generating enough returns for you to, you know, to beat the inflation, etc. That's where hybrid funds would make more sense. What is a hybrid fund? I mean, in general, we understand the concept of hybrid, combination of two or three, right? So generally, what hybrid funds do is they give you a combination of equity and debt in one single portfolio, and then manage it for you. So there are conservative hybrid funds which will give you, which will help you in beating the deposit returns by a slight margin. But there are aggressive hybrid funds which would help you in beating the inflation and deposit returns by a relatively bigger margin, right? So again, depending on your investment horizon, one can always look at choosing between aggressive hybrid or a conservative hybrid. Look at your tenure and so on.
But is the money divided? Let's say I put 1,000 rupees. Is the money divided 500 in equity, 500 in debt, or it depends on the ratio of the fund manager who's taking care of?
No, that is decided. That is decided at the
Okay.
scheme level itself. If you are investing in a conservative hybrid of a hybrid fund of any mutual fund company,
Hmm.
they invest around 30 35% in equity, the rest in bonds.
Okay.
Aggressive hybrid 65% plus in equity, 35 odd percent or around that in debt. There is
Good.
also categories of balance advantage. They keep toggling between equity and debt based on market conditions.
Okay.
Yeah.
I understand. But what I would want to know is in terms of all this perspective that you just given us over the last 1 hour, a lot of this information definitely you would have also gained definitely through your experience, but also through a lot of education that you would have taken.
Yeah.
So how important do you think, and for the viewers who are watching this, how important do you think is education about the financial market or about the different type of mutual funds or stock is important?
Oh, it is very important. Money management should be one of the basic life skills, right? I mean, like how people say one needs to know how to swim, drive, cook. I think managing our own money is also a very important life skill.
Hmm.
The best way to enable ourselves is to educate ourselves. When I say educate ourselves, is not something where we get into paranoia, read, study. At least you should know the basic framework. What is what? How does something work? What are the pros and cons? Okay, and then manage your money accordingly. Okay, don't overdo it, and at the same time, don't be ignorant about it. That's my take.
So you need to learn, and side by side you also have to practice and have a practicality knowledge about it, right? That is what you would.
Yeah, the practical knowledge is the best way of learning to swim is to jump into the water, right? That's the best way to learn swimming. So start
Plus,
investing, maybe start small and then learn, and then as you start learning based on your learnings, keep on increasing it. Yes.
amazing. So I think we are at 5 o'clock, but just on closing remarks from your end for everyone who's watching, what would you say? What is your experience been if you would want to say that quickly, and what is your message to everyone who's watching this?
Simplify your life. Have some money in fixed income side to manage your short term and emergency needs, but definitely take help of equities, in maybe in the form of SIPs for your long term wealth creation. So that is very important. To meet any of your long term goals, you definitely need the help of equity. So go through the experts, called as mutual funds. They will help you in managing your money.
Amazing. So with that, everyone, that is all the time that we have today. But before we go, I would really like to say a big thank you to Kathick for being here. And do not worry, we're going to get Kathick back again. Every month if possible. To time pertaining to him. But Kathick, thank you so much to be on our platform, Bullsmart Stock Academy, where we are trying to do exactly what you just spoke about, the education part of it, and we want people to then take that education and move on to our app the Bullsmart app and start investing in mutual funds from there. So thank you so much. It is a real pleasure to have you every time. You know that each time I meet you, this time I'm meeting you on a different platform, but definitely very soon we'll be meeting in person. So thank you so much for your time, and thank you everyone who been watching us. Until next time, be safe and keep investing. And do remember to like, share, and subscribe to Bullsmart Stock Academy. Thank you.
Thank you very much, and all the very best. Thank you.
Thank you. Yeah.